If there's one phrase that has been battered, thumped, and pounded repeatedly on the average Indian investor, then that's consistent compounders. So what is, or perhaps who is, a consistent compounder? Well, there's no one definition of it. For some, it's a company that gives consistent stock market returns. For others, it's the steady generation of profits. You might even quantify it as sales growth. And there's also a small segment of people who might just go with what Mr. Mukherjee says. Now, that being that, मैंने सोचा बहती गंगा में मैं भी हाथ धो लूं. And my own definition of compounders includes a total of 9 variables, which we'll study in this video and is a combination of qualitative and quantitative parameters. Let's begin. Alright, so let's start with the quantitative part, and the key financial parameter amongst compounders is a sustainable and high ROCE, which in turn is a combination of recurring revenues, high gross margins and low capital intensity. To kind of put this into perspective, I sourced a list of companies from Marcellus's CCP portfolio, and what clearly shows up is the high and consistent ROCE number. Actually, let's ignore the financial companies as the ROCE is not the right metric for them, but then look at the two paint companies, TCS, Page Industries, and look at Nestle India that according to screener.in is at an ROCE of 138%. Now, I'm not a big fan of most screening applications, and just for Nestle India, I should point out that while screener.in puts it at 138%, my own calculations based on the FY22 annual report comes to a much more placid but commendable level of 56%. Anyways, the point is, when I compare it with what Nestle India was a decade back, we see that while the operating earnings have more than doubled, the capital utilized to achieve these earnings have not grown at the same pace, which is what lifts the ROCE in this case. Fortunately or unfortunately, we have to use the screener somewhere, and unlike Robert Kirby, who used a 15% filter as part of his coffee can portfolio, I'll be working on a 20% ROCE spread across a number of years. This gives us 419 companies to work with, and because this is ROCE, you're likely to find a number of capital-light B2C companies in this roster. A second characteristic persistent with compounders is their ability to generate steady revenue and earnings growth over multiple years. This growth may not always be spectacular, but it should be reliable and sustainable. For example, the two leading paint companies in India have not only tripled their sales over the last 10 years, but have grown it rather consistently, which shows that their business and consequently their cash flows and profits are less sensitive to changing economic conditions. In other words, the nature of their product or service is non-discretionary and it comes with strong brand loyalty and repeat purchases. We'll revisit this part in the qualitative section of this video, but a modest top-line growth of at least say 12% over many years is certainly what I'm looking for, and when applied to a screener, this gives me 141 companies to work with. A third box that I think is an important ingredient in identifying potential compounders is the opportunity size. What I mean is, we want companies that have such long growth runways in front of them that they can continue growing for the next 20, 30, 50 years, and this marcellus list of companies is a historical proof of that. Now, this runway itself can be of two types. The first method is a bit like a fish in the pond, so either the fish is a small one, like how Indigo is within the paints industry with just a 2% market share, or else the pond itself is increasing, which is currently the case with sunrise sectors like renewables, e-commerce, online learning, and some specialty chemicals, which we discussed at length in a previous video. Now, while I have no idea how to draw this on a screener, it's my view that the identification of a consistent compounder does require estimating the company or that industry's addressable market, and there are tons of industry reports, government data and trade publications that can help you with that, including the BCG Monitor and FISDIM's CapView that I regularly consult. The fourth quantitative variable revolves around profits, and we want to look at it from a margins and a growth perspective. Okay, so growth first, and the metric that's of concern to me is not the net profit, but it's the EPS, the earnings per share number. Why? Well, by using EPS instead of net profits, we'll be able to standardize earnings, making it a lot easier to compare performance over time. It's a very simplified and useful valuation tool. It takes into account share buybacks and also dilution, that is the issue of new shares. And in my view, EPS is a better reflection of shareholder value, like what we saw with Adani Ports a few years back when their profits were up 25% while the EPS was down 6% on account of new shares being issued. Now, when it comes to margins, a high operating margin is always welcome as it reflects efficiency, sustainability, and strength in the company's business model, which essentially means on a screener, I'm looking for a consistent growth in EPS of say at least 12%, and I'll prefer using the same percentage, so 12% when filtering for operating margins as well. This brings down our universe to 76 companies, but pleasantly, I can still see some popular companies like Asian Paints, Polycab, PI Industries, Tata Elxsi, etc. within this list. And the last of my quantitative factors is the free cash flow, which as a crude definition means galle mein kitna paisa hai, that is what remains for the management to use internally or to distribute to the shareholders after having paid for all operating and capital expenses. For example, Marico Industries currently does 10,000 crores in sales, which translates to a profit of about 1,300 crores. And like all good companies, a lot of it comes as cash flow from operations. Incidentally, the Marico operation is so well oiled, no pun intended, that they are able to generate tons of free cash flow by spending just a little on their growth and maintenance capex. Now, I generally don't use this metric on a screener, and that's because firstly, the treatment and extent of free cash flows changes dramatically from industry to industry. It's a metric that works perfectly for established companies, but not as much for new or growing companies. And thirdly, a high FCF may also mean complacency, wherein the company is not pursuing growth opportunities aggressively, which might lead to challenges later. So there are different ways of looking at it, but generally a high FCF is always welcome. And if you want to try it that way, then we are looking for a 15% and generally consistent growth in free cash flows, which is what the large sized companies amongst our curated universe of 76 stocks have typically delivered. I should also mention that the list we have so far has a few very small companies, and when I restrict my research to companies with a market cap of at least 1,000 crores, then I'm left with 59 companies, which is a good sample size to work with. Alright, now let's examine the qualitative side of identifying consistent compounders. And the first thing we want is a high quality franchise. Now, a franchise is not a commonly used term, so very quickly it's a business that has strong recognizable brand with a good reputation. It has sustainable competitive advantages which can include a unique technology, exclusive rights, loyal customers, or a superior distribution network. The business has a strong track record of solid financial performance across different economic cycles. It continues to have good growth prospects, including new markets, geographical expansion, and the widening of its product base, and of course has enduring demand, which is often the consequence of its necessary nature or uniqueness. We'll revisit all of this with an example later, but the general observation is that it's difficult to find such companies in capital-intensive and cyclical industries like utilities, oil and gas, commodities, chemicals, automobiles, real estate, etc. In that context, more compounders are found in relatively capital-light B2C businesses. And if this marcellus list is proof of that, then very rightfully it features companies in the customer-facing domain that don't have big capital requirements to support their growth. So essentially, if you're looking for a high-quality franchise, then look at companies producing branded consumer goods like food and beverages, tobacco, household products, cosmetics, etc. You'll find a few in the pharmaceutical, media, and IT services sector. And also look at financial sector with top established banks, NBFCs, and insurance companies posing as suitable targets. And speaking of high quality, here's what the product team at Fisdom has been up to over the last 1 month. Firstly, the app is now a lot easier and faster to use with enhanced search feature and precision tagging. The stock information screen has been completely redesigned with a quick and fast toggle between F&O, analyst view, technical, fundamental analysis, and news events. You can now download a detailed report by Refinitiv for almost any stock in the market. The portfolio section has had a major facelift with intuitive display of one's holdings, profits, and also your short-term and long-term capital gains. There is integration with small case, and you can access a host of expert curated portfolios. And lastly, we have the newly launched mutual fund ratings by Fisdom's in-house research team, which is more advanced and real-time as compared to competing products in the market. The team at Fisdom is always at work to give you the best experience, and to enjoy these advanced features and benefits, download the Fisdom app today. As always, the link is available in this video's description. The second qualitative factor I look for when searching compounders is pricing power, which in simple words is the ability to increase the price of a product or service without risking a decline in sales. In this context, Warren Buffett said, and I quote, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, then you've got an excellent business, and if you have to have a prayer session before raising the price by 10%, then you've got a terrible business." Understandably, companies that can confidently raise prices are the ones that have deep competitive advantages, have few or no substitutes, and are generally tagged as essential items. Now, when we hear this phrase essential items, our first thoughts might be around sugar, rice, cement, or similar commodities. But one good example of pricing power is Vedant Fashion Limited, which has been able to not only maintain but increase their margins over time. And all this comes from the brand loyalty of this company, which has been gathered in spite of offering zero discounts on their product. The eighth variable in my list is the industry market share, and it is my belief that when seeking compounders, the relative strength of a company within its industry is even more important than the company's market capitalization. You see, compounders often enjoy high barriers to entry with strong market share in monopolistic or oligopolistic markets, which is usually a result of their intangible assets and their ability to continually innovate. My point is, the chances of finding a company that can grow consistently for the next 10, 20, 30 years is a lot higher with companies that dominate their industry, and that is what one should be looking for. The ninth and final variable is something I've discussed a number of times, and as Tom Gaynor rightfully said, we are looking for a management that has character and ability. As this was covered in that video, I won't go deeper into this, but do examine the management against these checklists to have a better idea on who is running the business and what they are capable of. In fact, one of the best ways to regularly track this is the quarterly earnings call, where analysts and prominent shareholders would seek answers on a host of topics from the CEO, CFO, and other senior members of the management. Many of these calls are quite revealing, and if you listen or read them over a few quarters, you'll develop a better appreciation of their quality, discipline, their greed, capital allocation thought process, and the short and long-term focus. So the 9 points I've covered is essentially how I shortlist a set of potential compounders. And while this was entirely screener based when I first started, but over time I've added and understood the importance of having qualitative variables as well, which should be amongst your primary learnings from this video. Now, the filtering process I've discussed comes to a list of 59 companies, and to help out, I've enclosed a worksheet link in the video's description that not only includes many of the variables we have discussed, but I've also graded these 59 companies on the basis of numbers, some subjectivity, and also my experience. So there is a lot there for you to work on, and I have every reason to believe that if you follow the process I've defined, you'll be able to identify a nice set of 15-16 stocks that will suitably serve your wealth creation needs. But let's do one thing. Let's pick one stock, an all-time favorite, let's say Asian Paints, and run the process that we have just learned. Okay, so Asian Paints needs no introduction. It's a company that was established in 1942, and I'm still amazed how some researcher figured out the revenue CAGR and ROCE across multiple decades. So let's start from here, and point one, which is on consistent and at least a 20% ROCE, is a definite tick for Asian Paints. The same applies for point 2, and the growth in sales has been adequately high and amazingly consistent irrespective of the prevailing economic condition. Point 3 is on opportunity sizing, and Asian Paints is already India's largest paint company. It's number 2 in Asia behind Nippon Paints and is ranked 7th on a worldwide basis. Now, this might give us a feeling that there aren't many expansion opportunities, but when I objectively look at it, with respect to domestic demand, the paints industry is slated to grow annually at 11%. Asian Paints is not just paints and has a broad portfolio of products including waterproofing, mechanized tools, adhesives, bath fittings, decorative lighting, and also services like bathroom design, safe painting, wood solutions, etc. The company has in-house paint manufacturing facilities in 14 countries outside of India, which already contributes 9% of the total revenues. The company's industrial business crossed the 1,000 crores mark in the last financial year, and Asian Paints is also entering the white cement manufacturing space through a joint venture, which the company is very excited about. A keen reading of the company's annual report and earnings transcript can give us all a better idea of the opportunity size and the growth potential, which is something all investors should be aware of. Point 4 in my compounder identification checklist are the profit margins, which at an operating level has been pretty consistent at between 16 and 22%, and also the growth in EPS, which has gone up every year except the COVID year of 2022, with the company doubling this number every 5 years. The fifth point is on growing the free cash flows, and Asian Paints has always been a strong FCF generator. Having said this, notice the capex number in this table and you'll see that 1,400 crores is the highest the company has gone in a financial year. I mention this because as per a recent transcript, the company's capex plan in terms of spends is expected to be in the region of 2,000 to 2,300 crores over the next 1 year, but that doesn't dilute the fact that Asian Paints has been a strong free cash flow generator, so that's another tick mark in my checklist. Point 6 is the tagging of Asian Paints as a high quality franchise, and there should really be no argument around this. After all, the company features amongst the top 20 of India's best brands. It has the widest and strongest distributor base with more than 1.5 lakh retail touchpoints, and the enduring demand for paint ensures that the business delivers solid financial performance across different economic cycles. Point 7 is on pricing power, and this is important because the paint industry is highly dependent on its raw material, which is majorly petroleum product. So when the cost of oil doubles, even triples, it is expected to cripple many industries including paints, but that's where Asian Paints is different, as it not only has been able to pass the rise in costs to its consumers, but has actually grown its margins. Next up is industry market share, and Asian Paints with 53% is the leader by a fair margin. And it is this dominant position that allows the company to enjoy economies of scale, which leads to lower cost of production and therefore higher profitability. And finally, we have quality management, which is something Asian Paints has in abundance, and the company continues to not only develop strong managers from within, but it often hunts for talent both within the industry and outside. Okay, so to put this together, Asian Paints Limited checks a number of boxes in our compounder checklist, but that still doesn't make it a great stock to buy unless we have done a valuation exercise on top of it, and that's something I'll take up in a follow-up video. However, in my opinion, and especially when it comes to compounders, my idea of a margin of safety is less to do with calculating the intrinsic value of a share, and it's more to do with building my confidence that a company's competitive advantages will stay strong or get stronger over time. In other words, the focus is on earnings potential, and sometimes a P ratio of 40, 50, even 80 can be justified for a company that has decades to grow, to flourish and generate value for its shareholders. As an example, let's take Asian Paints itself, which was available at a price earning multiple of 60 in January of 2015, and even today in October of 2023, it's pretty much at the same P ratio level. However, in these 8.5 years, the company has delivered an annualized share price growth of 17%, which it owes to the simple fact that the company's sales, cash flows, profits, and other variables went on to compound consistently. To conclude, and while it's true that very few companies have been able to consistently compound shareholder wealth at superior rates of return over the long term, and while identifying the right company will always be challenging, I strongly feel this 9-point methodology I've put forth will help you create a solid portfolio of such compounders. If you found the video useful and informative, please tap the like button. Do share this video with your friends, and I'll see you 3 days from now. Until then.